Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today is Macquarie Capital's Managing Director and Head of India Equity Strategy, Sandeep Bhatia. Sandeep, great having you. Thanks for taking the time out. Hope all is well.
All good. Thank you, Niraj.
Well,
fantastic to be on your channel. Congratulations.
Thank you so much. It's a pleasure to have you, Sandeep. And just wondering, it's a pleasure to be in the Indian equity markets, or for that matter, risk assets worldwide, because 2023 is turning out to be, if not a banner year, certainly a year to reckon with. It's been a year of steady gains.
Yes, it's always been a pleasure to be part of the Indian markets. Many people may not know, but in terms of dollar returns, the Indian equity market is up there with the best, which is the US market. So it's not Indian currency that we outperform. Over the 30 odd years that I've looked at the market, we have had market deliver over 12% dollar returns. So that's a fantastic number. And I think 2024 should be a strong year. 2023 has been a stronger year than anyone expected for India. Also for global markets. 24, barring any unforeseen, unpredictable circumstances, whether it's a return of some pandemic or some other bigger war, we definitely have a great year ahead for us in India.
Okay, well, and viewers, that's the case for a chat today. We will ask Sandeep Bhatia about what 2024 could look like for markets at large. So, frankly, just laying out what you will hear on the show over the next 20 odd minutes. One, his views on whether 2024 could turn out to be as strong a year as 2023 has been or more. What fund flows amidst all the macro hurdles, and Sandeep has a great insight into what global money managers as well as Indian money managers would be thinking, and what is it that they advise some of those guys, and of course the sectors which will show leadership in 2024. Let's start off with the market reaction to the high frequency events, Sandeep, and we know that it'll be a year wherein nearly 70 odd countries are going for elections. Maybe not all of them significant from risk assets perspective, but India and US certainly there. And we know that it'll be a year of interest rate cuts. The quantum may be debatable, but we will have them. How do you think risk assets react in or around these events, and then on the potential outcomes?
I think risk assets like less risk and like certainty,
sure,
and like predictability, and definitely want a stable policy environment. I think India gives you all of this right now. Risk of any unforeseen electoral outcome seems to have reduced after the 3 state elections. India's fiscal management, India's monetary management, I would rate at the very best level. People use the word sterling to mean the UK, but in fact, I would think that India's management of its fiscal and monetary situation is actually sterling. It's genuinely a great place, both in terms of fiscal outcome, where tax rates have gone, tax revenues are gone up, and despite a lot of criticism that RBI regularly faces, it's also been able to moderate and manage interest rate environment. So given this, I think risk assets in India at least will perform well. The real challenge still remains in Europe and US in that order. US can have an unpredictable election outcome in November 2024. The presidential elections happen in the US. It seems the Republican contender is in the front run. So that is possibly a change of direction in politics and policy. European Union seems to be fraying at its edges, and therefore risk is increasing everywhere in that continent. So I think in that background, India seems to be a great place to be in and should be for 2024.
I'm just wondering, Sandeep, since you raised that point, I'm inclined to ask you, with both the Democrats and the Republican president before Joe Biden, India has per se had some good relations. So from an Indian perspective, would the US election outcome matter significantly more, or would it be yet another event, if you will?
See, Niraj, I have always said this. It's now fashionable to say it, that India is such a large country and it carries so much weight with both its population and its economy right now, that a lot of things happening outside that do not move this large ship. But the real challenge, I think, is in how the world and the direction the world is moving in. And if there are policy changes elsewhere, the growth environment for the world is getting more and more constrained. The free trade environment is going away. Both Europe and US will turn very protectionist. We were told about free trade in college and all through our initial working years. That's the best thing. India was put under pressure in the 90s and 2000 that it was not open enough. And I think that was a good and a fair criticism about India. And now if you look at both Europe and USA are closing its doors. So clearly politics trumps economics all the time. And politics can potentially change in the West. And that means that growth for exports from India could be under challenge. So that is a negative impact. The other thing which can happen is that the trust, which is the basis and foundation of all business relationships, especially trade, trust is eroding in the world. It's impossible to quantify. No economist will put a number on that and how much trust is positive. But we have seen that whether it's the family or whether it's the country or whether it's the global world order, lack of trust will reduce growth, and that has an impact on India.
Fair call. Okay, Sandeep, rate cuts are discounted already, you reckon, or when the events actually happen, whether it's 3, whether it's more, whether it's in Feb, whether it's in March, or whether it's in June, but when the event actually happens, would the markets get more excited by them?
I don't think the market should get more excited just because a rate cut has happened. It may happen for a week or so. It's not structural in the sense that it's not new. Rate cuts have been priced in the West and in India. We have seen 10-year bond yields go down in the US. That's the reference rate for interest rates globally. So to that extent, markets move ahead of events. And when the event happens, it's mostly always discounted.
Okay. So, Sandeep, one more question on the macro side, and then, of course, we'll try and dabble into the micro as well. But I hear from a lot of people who speak to FIs, either managing money for them or doing research and talking to them about how there's a whole new clutch of foreign money that is wanting to look at India afresh or increase allocation. I would love to understand from you, what is your thesis around this? What is your experience here?
See, what's essentially happening is that China has become uninvestable by basically saying that 35% of the MSCI index is China, and India is going up in terms of the weightage it has in the index. It's over 16, 17, 18%. As it goes up, more money definitely as a proportion of the total money has to come up because that's a larger portion of the entire pie, which India is. And more importantly, I think the confidence in policy level in China is extremely weak. We've seen time and again policy announcements even this week on the gaming sector. All the video gaming sector and the stocks in China took a big hit. So policy environment in China is clearly questioned. And also a lot of companies and a lot of businesses find it very difficult to operate freely in China. So it's a combination of, as I said, trust, and B, the fact that India is now the only large market that we can expect the West to easily operate in. If you look at even companies such as Apple and Samsung in China, they're facing barriers to their phones getting sold. So across the board, there are issues. It also flows in the financial markets that people feel that in China, policy environment is so fluid and so, so uncertain that might as well not invest in this market. We see sovereign wealth funds come in. We see a lot of even funds which were based in the US or in Europe, which were primarily looking only at China, actually now start talking to us because China, even those funds want now to invest in India. Most of these funds will actually be, have senior partners which are Chinese, of Chinese origin, but now are trying to learn India, come to India, and we have been hosting a lot of people who are from that background.
Okay. One more question out here, because you would have probably had a host of these conversations. Are the FI clients that you talk to, Sandeep, balking at the valuations that India has, or are they now taking the stride that India is always expensive? Because you would be telling them or giving them a slice of the history as well. Are they balking at these valuations, or are they taking it in their stride? And do you reckon 2024 first half, because election results now seem to be a foregone conclusion, that what could have been a decision taken post-May now could be preponed as allocations open up of 2024?
First quarter is a very good month for flows and for investment decisions. And you are right. I think there's a preponement of decisions. There's an assumption that the current government comes up with some kind of a majority. Maybe not as the worst case outcome will be that it will be a lower seat tally than what we had in 2019, but definitely still a majority government is the base case assumption. So clearly, investments are going to happen on the basis of that, and people will prepone those decisions. The good thing or the real challenge is what sectors to look at, I think. And everyone knows that FIs have been overweight financials. They've been trying to get into other sectors. And that is the real decision to be made. Whether to invest in India or not is not the decision, but where to invest and whether you definitely think that there's a broader rebound happening is the question. As far as valuations, which is your first part of your questions, valuations and India's quality of companies is far superior to what we see in Asia. And therefore these valuations are grudgingly definitely accepted.
Okay, then we talk about what Sandeep says is a more important part. I think I got the headline for this conversation already, which is whether to invest in India or not is not a decision for the FIs. Where to invest in the decision. We try and understand from Sandeep Bhatia on the other side of this break about what is it that they are advising their clients to do about where to invest. Back with Talking Point right here on NDTV Profit in conversation with Sandeep Bhatia of Macquarie. Sandeep, thanks for staying by. Now, before the break, you told us that whether or not to invest in India for FI is not a decision. Where to invest is the decision. I would love to understand what is your and your team's thought process about where is it that from these valuations and levels that we are at are there investment opportunities?
So, the consensus, as I was saying, has been to invest in the financials. It's the largest sector, both in terms of market cap and contribution to earnings. But I think in 2024, we could look at less loved sectors. These less loved sectors could be consumer goods, consumer staples, which have been an underperformer for not only last year, but over the last couple of years, they've been underperforming. We could definitely look at some of the public sector banks. We could definitely also look at the tech sector. The tech sector has been a bit of a dog this year with all the uncertainty around the US, but I think at least as far as interest rates are concerned, the uncertainty has receded. So the tech sector could be a good place to start investing. It doesn't mean that you go completely underweight the financials, but within the financials, I think cheaper banks like State Bank of India look good now. Even in the IT sector, whether it's LTI Mindtree or HCL Tech or TCS, which all look good. So I think raise the rates in sectors which have been less loved through the first and the second quarters of the 2024.
Is it the valuation argument out here, Sandeep? Because when you look at the commentary, I was looking at some notes even yesterday from companies, or the conversations that we've had with companies in the last, let's say, 2-3 odd weeks. The possibility of commentary looking upbeat even in the Jan quarter is not very high, for tech at least. Let's start off with that. So is it a valuation game?
I agree with you. Yeah, so the commentary will not be good. And that's why I said, do it over 6 months, do it in a phased manner. But valuations are clearly good. And it's unlikely that, if there's a broader rebound in the US, the tech sector will not benefit. But yes, it is not a clear winner in the first half of the year. I would agree with that. Valuations are a reason to look at it. And so also the other thing which you have to remember is that you cannot be overweight one sector or one kind of theme all through the cycle. The market does move, and market will move without you getting any warning. We saw that in December, that the tech sector had a big run once it was clear that the US rate cycle had eased. So you will see that also happening. Sector rotation is a theme which will play out, and the best time will actually be post-elections, May, June. Once the new government is in place in July, we expect the full budget for the year to come through. Around that time, the entire domestic consumption, domestic investment story can also be a good place to start.
Okay, interesting. Sandeep, what about the loved sectors? I mean, they are the conversations that we have with companies which have done really well. Mid cap, small cap, large cap, from defense, from railways, from what have you, EMS, for example, their projections for growth are stupendous. So would growth make up for the steep valuations, or will there be a time correction possibility in, let's say, 2024 for some of which have really had a good run?
Great question, Niraj. It's really imponderable. It's, to be very honest, growth pays for valuations. Definitely, if growth continues for 3+ years, this is the scenario that the market is pricing in, that growth will continue for more than 3 to 5 years. And all these sectors, which are defense, in fact, if you look at today's international newspapers headlines, you'll say that global defense spending is now on a high with all the wars happening around the world. So that's a headline which is running in some international pink papers today. So I agree with you. Growth will pay for it. If there are no unforeseen circumstances, these will continue to be sweet sectors to invest in. But I think there is an element of, everyone will tell you to become an engineer. Everyone will tell you to become a doctor in your family. So investors also do the same thing. If something is doing well, they continue to pile on there. It's very difficult to be anti-consensus and to take a new path, whether it is your career or whether it is investing. And therefore, over a long period of time, diversification into these sectors, which are currently seen to be not the best, but can come through in the second half of the year, especially after June, July, as I was saying, we could look at those investments in the beginning of the year.
Okay, that's an interesting point, Sandeep, too. One final question before we wrap this up. Since you mentioned about unloved pockets, but which are starting to get loved in my mind, we've seen the last few days a clutch of spec chem, pharma, API related companies, which have started to come back. But the problem is that they are so globally exposed that global headwinds might not allow the businesses to grow well. My question, therefore, is that some of these manufacturing-led businesses which have this global export revenue, are they providing a good opportunity, or is that some time away?
See, my basic thesis is that at least physical goods and trade in physical goods globally is going to get restricted. There's a move to close down borders for movement of both people and materials and goods. Every large country, especially let's say the US or even Europe, and of course we see that in China, is trying to make all of its resources, control the manufacturing within their own borders. That is a theme which happened when India started Make in India 10 years ago. People thought that India was closing its borders, but actually Make in US or Make America Great Again, or China trying to control its entire manufacturing is happening across the globe. So if you are extremely dependent on export of goods, that depending upon where you export to, if you're exporting to a friendlier country from India, then it's still okay. But otherwise, it could be a challenge. So I might as well focus on domestic stories and also on stories where it's not goods which are getting shipped as much.
Got it. Sandeep, take a moment to thank you for joining me today. Extremely lovely having you closer to the end of the year. Wishing you and Team Macquarie and family a very happy 2024.
Thank you. Best of luck to you and your viewers for a great 2024.
Thank you so much, Sandeep. Much appreciate. And viewers, thanks for tuning in to yet another episode of The Talking Point.